Question 26. Okay, I'm going to go directly to the questions. The question asking for worksheet entries to consolidate these two companies as of December 31st to 2018, and then compute the net income attributable to the non-controlling interest for 2018. So in order to solve this question, first we need to have some preparation. First, let's prepare the excess annual amortization related to the subsidiaries accounts that have different fair value from book value, and so the first one we have is contract, which is undervalued by 60,000. It has 20-year remaining life, so every year there's going to be 3,000 excess annual amortization. And then second one is the buildings, which is undervalued by 20,000. It has 10-year remaining life, which means that every year there's going to be 2,000 excess annual amortization. In total, there's going to be $5,000 excess annual amortization related to those as subsidiaries assets that have different fair value from book value. Next, we need to prepare some consolidated entries related to the intra-entity transactions. First is let's have a look at the inventory. So there are inventory transfers, and the inventory is transferred from the subsidiary company to the parent company, which means that this is the upstream transfer. Okay, so this is the upstream transfer. And then the cost or the adjustment related involved in those entries are going to impact the subsidiary company's adjusted income. Okay, so because let's just prepare the consolidated entries for 2018, and because there are some remaining inventories coming from last 2017, so the first entry we need to prepare is this entry star G to recognize deferred profit from last year. And because this is upstream, so this star G we debit retained earnings and credit cost of goods sold. And so deferred amount is going to be the remaining inventory, 5,000, and times the gross profit in last year. And how I get the gross profit? Gross profit equals to its selling price minus cost and divided by the total selling price. That'll give us 40%. So next entry is entry TI. So entry TI is to eliminate current year intra-entity sales. So debit sales 20,000 and credit cost of goods sold 20,000. The last one is entry G. Entry G is to defer the unrecognized gross profit in this year's current year's unsold inventory. Okay, and then for 2018, the gross profit margin is equal to its 2018 inventory selling price minus the cost and divided by the total sales, 45%. And then for the deferred profit, it equals to the unsold inventory and times this 40%, we get 4,500. So those are the profit have to be recognized in the following period. Alright, so that's the entries related to the inventory transfer. And next we have the equipment transfers. For the equipment, is sold from the parent to the subsidiary, which means this is the downstream transfer. Okay, so this downstream transfer, and still let's prepare the consolidation entries for 2017. So that will be helpful for us to prepare entries for 2018. So in 2017, when we have this transfer, so that's going to be return earnings, so debit gain. So with debit gain on sale and credit, we use entry TA to eliminate this gain on the sale of the gain in this intra-entity asset transfer. Same time we credit buildings to adjust building back to its true book value, because the buildings is overstated when the parent sell its buildings at a price higher than its book value. Okay, so that's entry TA, and second entry is entry ED. That's because building is overstated, so which means that there are overstated depreciation expense associated with it. So we need to reverse that. And the way to get the depreciation expense for the year is equals to the overstated amount and divided by the remaining life. Assume that they are using straight line method. Well, okay, so that's 2017's entry, and for 2018's, it's going to be very similar. So for entry TA, star TA is to still use star TA to bring the building back to its true book value, because after 1 year depreciation, so the new amount for the buildings overstated amount is 24,000. It's equal to the 3,000 minus 1 year depreciation. Well, in this case, because this is a downstream, and also because parent company are using equity method, which is the it's because the equity method is used. So instead of using return earnings, we debit investment in subsidiary company. So this is a very important part. Okay, so that's the star TA, and then for the entry star ED, it's the same as entry ED, is because the depreciation expense is the same every year. So we debit accumulated depreciation and credit depreciation expense $600. Okay, so that's the next preparation. In the next video, I'm going to give you the consolidation entries. So let's continue to working on other consolidation entries. The first is entry S. We use entry S to eliminate subsidiary companies' equity account balance. We debit common stock, and we debit retained earnings. The amount is 120,000 for common stock, and the balance, the amount for retained earnings is 250,000. It equals to the current unadjusted balance of 260 and minus 2,000. So this $2,000 deduction coming from the entry star G is because at the beginning of 2018 we use entry star G to recognize deferred gross profit due to this inventory transfer, and this is upstream transfer. So the amount we adjusted here is related to the seller, and the seller is the subsidiary company. So here we debit return earnings by 2,000, means that we are going to deduct return earnings by 2,000. So that's why we use 260,000 minus 2,000 to get 250,000. All right, so that's those are the debit accounts, and then we are going to allocate 80% of the total debit to investment in subsidiary and allocate 20% to non-controlled interest. All right. Next one is entry A. We use entry A to adjust those subsidiary accounts that have different fair value from book value. And we have two accounts here, contract buildings, and their amount equal to its original fair value allocation and minus 2-year amortization or 2-year depreciation. Still, we are going to allocate 80% of the total debit to investment in a subsidiary account and allocate 20% of the total debit to non-controlled interest. Next one is entry I. Entry I is to eliminate intra-entity income from subsidiary company. We debit income from subsidiary company 10,600 and credit investment in subsidiary company. And how I get this amount? And so the information tells us that in 2018, 130,000 is the total sales of the subsidiary company, 70,000 is cost of goods sold, 40,000 is operating expense. And also we have some adjustment related to this subsidiary company's expense that's related to its upstream sales, right? So in the upstream sales, we remember that first we recognize $2,000. This is a deferred profit, recognize the deferred profit. So we plus 2,000 and we minus 4,500. This 4,500 is related to the unsold inventory in this period. So we need to deduct that from the net income. Next one is $5,000. This is the annual amortization expense related to the excess annual amortization schedule. That's 5,000. We need to deduct that as well. So $12,500 is actually the net income from subsidiary, but this I is a little bit complicated than that is because there is an intra-entity buildings transfer, and for this buildings transfer, because this is downstream transfer, and also the parent is using equity method, so it's going to adjust its investment account and return earnings for that period by credit $600 from the investment account. That's why we need to plus additional 600 related to this excess depreciation expense to this total amount. So that's why I get 10,600. That's for entry I. And because there's no dividend, so there's no entry D. And entry E is to recognize the excess annual amortization and depreciation that's related to the buildings and the contract. Okay. And then last question is what's going to be the net income to non-controlling interest, and that should equal to 20% of the adjusted income from subsidiary company. That is we get 2,500.